Thank you, Senator Toomey. Chairman Brown, Ranking Member Toomey, members of the committee, thank you for inviting me. We're meeting at a hopeful moment for the economy, but still a daunting one. While we're seeing signs of recovery, we should be clear-eyed about the hole we're digging out of.
Figure it out. You want to?
The country is still down nearly 10 million jobs from its pre-pandemic peak. When Congress passed the CARES and Consolidated Appropriations Acts last year, it gave the federal government some powerful tools to address the crisis. But upon taking office, I worried they weren't powerful enough. After all, there were and still are some very deep pockets of pain in the data. 1 in 10 homeowners with a mortgage are behind on their payments, and almost 1 in 5 renters are behind on their rent. There are 22 million people who say they don't have enough food to eat. 1 in 10 adults are hungry in America. I looked at data like these and I worried that the COVID economy was going to keep hurting millions of people now and haunt them long after the health emergency was over. We know that when the foundations of someone's life fall apart, when they lose the roof over their head or the ability to eat dinner every night, the pain can weigh on them for years. Their earnings potential is permanently lowered. I worried about this happening on a mass scale. That's why I advocated very hard for the American Rescue Plan. And it's why my first and most enthusiastic message today is thank you. With the passage of the rescue plan, I'm confident that people will reach the other side of this pandemic with the foundations of their lives intact. And I believe they will be met there by a growing economy. In fact, I think we may see a return to full employment next year. Of course, the speed and strength of our recovery depends in part on how we implement the legislation. Treasury is tasked with much of that work, and there's nothing that I or my team take more seriously. We appreciate your oversight on this matter, and I want to briefly tell you about how we've been working. Since taking office 2 months ago, we've been expediting relief to the areas of greatest need. For example, small businesses, and especially the smallest small businesses, which are disproportionately owned by women and people of color. The pandemic has hit these businesses hard. The Paycheck Protection Program was an early lifeline, but because of issues with the program's design, the first rounds often didn't reach the smallest sole proprietorships. We're addressing that now. We worked with SBA to tweak how the program was implemented. It's allowing the PPP to reach millions more micro businesses and entrepreneurs, especially in rural and low-income areas. We're also building capacity to support these communities over the longer term. Because of the December legislation, Treasury now has $12 billion to inject into community development financial institutions and minority depository institutions. In turn, these CDFIs and MDIs can lend that capital out, helping people buy homes and start businesses in places that the financial services sector traditionally hasn't served well. Then there are the families I spoke about, the ones struggling to keep a roof over their head and food on the table. The American Rescue Plan provides more than $30 billion to help renters and homeowners at risk of losing their homes. And we're making sure that assistance flows as efficiently as possible. For instance, the previous administration put in place rules that required tenants and landlords to provide quite a bit of documentation to get rental assistance, including detailed statements about their income. But some people don't have access to those documents. We're cutting through the red tape for them while still taking reasonable steps to prevent fraud and abuse. And of course, we've been sending direct payments to Americans, a lot of Americans. As of last week, we had issued over 90 million payments. And all this is just a fraction of Treasury's work. There are so many more relief programs, including one that will provide $350 billion in aid to state and local governments. Implementing all of it is more complicated than it sounds, and we're working closely with stakeholders to make sure that these programs are both efficient and effective. Behind these many relief programs, these millions of transactions, are a staff of very dedicated and very tired Treasury and IRS employees. My final word is to them. Thank you. You're putting on a masterclass in how government should work in the furnace of a crisis. I'm grateful to be your colleague. With that, I'm happy to answer any questions you have.
Thank you, Secretary Yellen. Chair Powell, you're recognized for 5 minutes. And thank you, Ranking Member Toomey.
Chairman Brown, Ranking Member Toomey, and other members of the committee, thank you for the opportunity to discuss the measures that we've taken to address the hardship wrought by the pandemic. I'd like to start by noting the upcoming one-year anniversary of the CARES Act. With unanimous approval, Congress provided by far the fastest and largest response to any post-war economic downturn, offering fiscal support for households, businesses, healthcare providers, and state and local governments. This historically important legislation provided critical support in our nation's hour of need. As the virus arrived in force, our immediate challenge was to limit the severity and duration of the fallout to avoid longer-run damage. At the Fed, we also acted with unprecedented speed and force, using the full range of policy tools at our disposal. Today, the situation is much improved. While the economic fallout has been real and widespread, the worst was avoided by swift and vigorous action from Congress and the Federal Reserve, from across government and cities and towns, and from individuals, communities, and the private sector. More people held on to their jobs, more businesses kept their doors open, and more incomes were saved. But the recovery is far from complete. So at the Fed, we will continue to provide the economy the support that it needs for as long as it takes. As we've emphasized throughout the pandemic, the path of the economy continues to depend on the course of the virus. Since January, the number of new cases, hospitalizations, and deaths has fallen, and ongoing vaccinations offer hope for a return to more normal conditions later this year. In the meantime, continued social distancing and mask wearing will help us reach that goal. Indicators of economic activity and employment have turned up recently. Household spending on goods has risen notably so far this year, although spending on services remains low, especially in sectors that typically require in-person gatherings. The housing sector has more than fully recovered from the downturn, while business investment and manufacturing production have also picked up. As with overall economic activity, conditions in the labor market have recently improved. Employment rose by 379,000 in February, as the leisure and hospitality sector recouped about 2/3 of the jobs that it had lost in December and January. The recovery has progressed more quickly than generally expected and looks to be strengthening. This is due in significant part to the unprecedented fiscal and monetary policy actions I mentioned, which provide essential support to households, businesses, and communities. However, the sectors of the economy most adversely affected by the resurgence of the virus and by greater social distancing remain weak, and the unemployment rate, still elevated at 6.2%, underestimates the shortfall, particularly as labor force participation remains notably below pre-pandemic levels. We welcome this progress, but we will not lose sight of the millions of Americans who are still hurting, including lower wage workers in the services sector, African Americans, Hispanics, and other minority groups that have been especially hard hit. The Fed's response has been guided by our mandate to promote maximum employment and price stability for the American people, along with our responsibilities to promote the stability of the financial system. When financial markets came under intense pressure last year, we took broad and forceful actions, deploying both our conventional and emergency lending tools to more directly support the flow of credit. Our actions taken together helped unlock more than $2 trillion in funding to support businesses, large and small, nonprofits, and state and local governments between April and December. This support, in turn, has helped organizations from shuttering and put employers in both a better position to keep workers on and to hire them back as the recovery continues. Our programs served as a backstop to key credit markets and helped restore the flow of credit from private lenders through normal channels. We deployed these lending powers to an unprecedented extent last year. Our emergency lending powers require the approval of the Treasury and are available only in very unusual circumstances. Many of these programs were supported by funding from the CARES Act. Those facilities provided essential support through a very difficult year. They are now closed, and the Fed has returned the large majority of Treasury's CARES Act equity as required by law. Our other emergency lending facilities are following suit imminently, although we recently extended the Paycheck Protection Program lending facility for another quarter to continue to support the PPP. Everything the Fed does is in service to our public mission. We're committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible on behalf of communities, families, and businesses across the country. Thank you. I look forward to your questions.
Thank you, Chair Powell, and thank you, Madam Secretary. Chair Powell, do you think all this fiscal support will help us get to full employment and improve our overall economic and GDP growth?
I think that the fiscal support that Congress has provided since the beginning has been really at the heart of the recovery and deserves much of the credit for the strength of the recovery over the course of the last year. I'm loath to comment on particular fiscal bills, as you know, but I would just say generally this situation really called for a strong fiscal response, and we've certainly had that.
Thank you. Secretary Yellen, how does the American Rescue Plan help women and people of color and the workers who've so often been left behind in our economy?
Well, the rescue plan is very much focused on getting aid in a whole variety of ways to those groups, starting with unemployment insurance, rental assistance for people who are in danger of losing their homes, food assistance, assistance to small businesses, especially in low-income minority communities, just aid to state and local governments, much of which can be directed toward those groups that have been most adversely affected by the pandemic. So there's also child support, an increase in the child tax credit to help families with burdens, household burdens. There's an expansion of the child and dependent care credit that will help women who are at home, have it with family responsibilities, get back to work. So a broad range of features that are directed at those groups.
Thank you, Madam Secretary. And I noticed one of the first things you mentioned is particularly of interest in this committee, and that is the work that a number of my colleagues did to help renters pay their bills and keep roofs over their heads and a roof over their head. I hope you'll continue to work with state, local, and tribal grantees to help this out, to get this help out to renters quickly. Secretary Yellen, do you think people are getting, thank you, do you think getting people vaccinated as fast as possible, as the Biden administration, as the American Rescue Plan are doing, does getting people vaccinated as fast as possible, does that help the economic recovery?
Oh, yes, absolutely. As Chair Powell indicated in his own remarks, ultimately the economic recovery depends on success in getting the pandemic under control, and vaccinations are critical to our ability to accomplish that.
And Chair Powell, as you had said earlier, you obviously agree with Secretary Yellen on that from what you said earlier. Do you think, Chair Powell, do you think direct payments to families help the economic recovery?
Again, I'm reluctant to, these matters are for Congress, not for elected representatives, not for us. Nobody has elected us to make those decisions. I would just rather say at a high level, I think fiscal policy has provided a lot of support, and that's been appropriate.
Secretary Yellen, do you want to expand on that same question briefly, direct payments helping the economic recovery?
Well, I think the direct payments are providing support to families for a wide range of burdens that many have suffered over the last years. There's other support that's clearly targeted, but I think this is helpful, in the spending that it will produce will speed the recovery.
One last question of both of you. Secretary Yellen, do you think that banks buying back their stock helps the economic recovery?
Um, I I have been opposed earlier when we were very concerned about the situation that banks would face about stock buybacks, but um, the financial institutions look healthier now, and I believe they should have some ability to, abiding by the rules to make returns to shareholders.
Okay, my last, even though I said that was the last, my last joint question to both of you, to each of you. What are the lessons learned from the pandemic's impact on the economy that we should use to make the economy and financial system more resilient to the impacts of climate change? Do you want to start, Chair Powell, on that and then close with Secretary Yellen?
So on climate change, I'll just quickly say that, we have a mandate to supervise financial institutions and one to look after financial stability. So we don't have a mandate to do anything in particular regarding climate change. We look at it as only to the extent it's within those particular existing mandates. And as you know, we are in the early stages of trying to understand what the implications are for both for financial stability and for on a micro-prudential basis for individual financial institutions. How should they think about those risks and ultimately manage them over a longer period of time?
Secretary Yellen.
Yeah, I agree with that. I think it's very important to make sure that financial institutions are resilient to the risks from climate change as well as other risks. And I think it's important for regulators to assess those risks, both to understand them and to help the institutions themselves understand and manage their risks.
Thank you, Madam Secretary. Ranking Member Toomey is recognized.
Thank you, Mr. Chairman. I just have to observe, if you pick up almost any newspaper in towns across Pennsylvania in the last week or so, a prominent story has been recurring all across the state. That is the story of mayors and township commissioners and county commissioners meeting to try to figure out what in the world they're going to do with this mountain of cash that just got dropped on them after having collected all the revenue they expected last year. In some cases, it's 50% of their entire budget. Really, just extraordinary. My question, I'll start with Chairman Powell. And what I'd like to do, Mr. Chairman, is follow up on the conversation we had last week. I want to kind of understand how the recent Fed projections fit together, because in some ways there are some apparent outliers. At least it appears that way to me. What I'm referring to is, the Fed's recent revisions, economic forecasting revisions, have a very significant upward revision in GDP growth. 6.5%, I think, is your real GDP number for this year. Not inconsistent with where a lot of private economists are, but that's a 2.3 percentage point increase. The unemployment rate that you project is only a decline of 0.5%. And the inflation rate, over the course of the full year, you guys are projecting that it will come in lower than it's been for the last 3 months. So on average, for the remainder of the year, you're implicitly projecting inflation to decline. So I think most economic models that would have that big an upward revision in economic growth would have a stronger reduction in unemployment and higher likelihood of inflation. And my concern is, if your models systemically were to understate the progress we're likely to make on employment and understate the risk of inflation, of course, it could lead to accommodative policy that goes too far for too long. So can you walk us through why you have a relatively small improvement in the unemployment rate and a declining inflation despite the strong GDP growth?
I'd be glad to. Let me start by saying that what we publish in the summary of economic projections is just that. It's individual projections that are totaled up and tabulated, really, not it's not something we vote on, but I'll address the medians, which are what we publish. So the reason that unemployment doesn't go down further, given the level of growth, is really just that we see participation expanding on it's a different margin. It's people coming back into the labor market, and that actually holds the unemployment rate up. It's a highly desirable outcome. But this was the biggest drop in participation since World War II. That's part of it. There are a bunch of other things that go into it. And of course, there's a good amount of uncertainty around that. On inflation, go ahead.
I'm just, my concern is because obviously private sector economists are aware of the decline in the workforce participation and they seem to come to different conclusions. But I understand this is an art, not a science. Let me just, so I'm going to run out of time here, direct my next question to Secretary Yellen. But first, on the topic of IMF SDRs, I do want to thank Senator Kennedy for his leadership on this issue. Madam Secretary, as you know from our conversation, I'm very concerned about the issuance of another $500, $600 billion of SDRs in the name of helping poor countries respond to COVID. SDR allocations are not meant to be a source of foreign aid. That's the realm of Congress to decide whether or not to extend foreign aid. And as you yourself have pointed out, this is an extremely inefficient way to deliver that aid, since the money goes mostly to G20 countries that have no need for this. So I'm just wondering why it is that you seem to have changed your position on the desirability of using SDRs for this purpose. And is this a final decision that's already been made, or is it still in flux?
Well, before committing to it, we will certainly, as the law requires, consult with Congress. I would say that the current crisis has increased the need for global reserves, and that's the IMF's assessment. The global economy suffered a very severe collapse in 2020. It contracted by 3.5%. The emerging market and developing economies face considerable external financing needs, and an SDR allocation will help countries meet this need for reserves without forcing them to tighten fiscal policy, which could lead to further global divergence. Now, this is a joint effort of the global community, and there's broad support for an SDR allocation. It's true that rich countries will get SDR. That's how it works. It's tied to each country's quota in the IMF. But many countries have indicated a willingness and desire to recycle the SDRs they receive, either in the form of loans or grants, to low-income countries. And so that will magnify the impact of the SDR allocation in terms of providing resources to low-income countries.
I see I'm out of time. Thank you, Mr. Chairman.
Thank you, sir. Senator Reid from Rhode Island is recognized.
Thank you very much, Mr. Chairman. Welcome, Madam Secretary. Good to see you.
See you, Tiff.
We are all interested in getting everyone back to work. You've indicated, though, recently that it could be a full year until we reach full employment. In that interim, would you support enhanced unemployment benefits? I think the American Rescue Plan has done a great deal to help the unemployed, but that effort, I think, should continue. Your views, please.
Well, I think, unemployment remains high, and it's important to provide the supplementary relief in the ARP, and that begins to expire, I believe, in the fall, when I believe the economy will be getting back on its feet. People have raised concerns about whether or not this additional aid will deter people from going back to work. That's certainly not an issue when unemployment is as high as it is now. And studies that have been done suggest that people receiving this have been accepting jobs. It hasn't deterred work. But I do think it's appropriate, as the economy recovers, and I hope it will by the fall, that should be phased out.
Just a follow-on point. I've noticed coming from Rhode Island in past recoveries, some areas come back much faster for many different reasons. Some are slower. In the last major recession, Rhode Island and Nevada lagged behind significantly. Would it be appropriate for states to qualify for extended benefits if they're over a certain level of unemployment, and even if other states have sort of broken through?
Well, I think, the experience we've had suggests that the time may have come to modernize our unemployment system and to look for ways to tie the generosity of unemployment benefits to local conditions, or to put in place automatic stabilizers that tie to local conditions and to national unemployment rates. So that is an adjustment that would seem sensible to me.
Thank you, Madam Secretary. A further question. Let me thank you because you responded to a letter that Senator Collins and I sent you with regard to the Coronavirus Economic Relief for Transportation Services Act, or the CERTS Act, which actually helps immensely the motor coach, school bus, and passenger vessel companies around the country. Can you give us an idea of when you'll be issuing the guidance for the distribution of these resources? Because these companies are really hurting.
Well, I know they're hurting. They're mainly small businesses. It's a highly complex new grant program, and unfortunately, our need to better understand eligibility and how to get money out to and inform those who are eligible for it. We've been working very hard on this, done a lot over the last couple of months, but we're working very hard to build an online application portal and to write up the standard agreement. So I hope soon we'll be able to get it out. It turns out that there are a large number of companies that are eligible. We expect the demand to be very large relative to the $2 billion in funding that's available, and we'll have to sort through how to allocate it fairly.
Thank you. Chairman Powell, I have just a few seconds left, but we spoke about this previously, bottlenecks in the world economy, and today we have a classic example. The Suez Canal is tied up. But how are you reflecting those bottlenecks in the supply chain in your outcome, if at all, or your projections of economic growth?
Yeah, we have a literal bottleneck in the Suez Canal today.
Yeah, we do.
Yes, we're monitoring all of that, and our staff is trying to model that as well. So we do have some slowdown in production. What's happened is that COVID has changed both demand and supply in some cases, and we're seeing with chips that go into cars now. We're seeing it there. We're seeing it at various places in the economy. The sense of it, though, really is that there'll be a little bit slower growth and maybe some modest upward pressure on prices of those goods. But that should be something that is temporary. A bottleneck by definition is temporary as the supply side adjusts.
Thank you very much. Thank you, Mr. Chairman.
Thank you, Senator Reid. Senator Shelby from Alabama is recognized. 5 minutes.
Thank you. Thank you, Mr. Chairman. Secretary Yellen, in 2017, when you were chair of the Federal Reserve, you noted that it was concerning to you that the U.S. debt to GDP ratio was about 75% at that time. Today, the Congressional Budget Office projects debt to reach 102% of GDP at the end of 2021. Is the nation's growing debt something to be concerned about? And if not, why not? Because it seems like we're layering more and more debt because of the crisis and so forth.
So, of course, our finances need to be on a sustainable long-run path, and that's a very critical responsibility for all of us. My views on the amount of fiscal space that the United States has, though, I would say have changed somewhat since 2017 when I said that. And it's partly because the interest rate environment has been so very low. And most economists and observers believe that interest rates have been trending down in developed countries now for several decades, that trend predates the financial crisis and is likely to continue. And what it means is that whereas in 2007, when we had a 35% debt to GDP ratio, now it's closer to 100%. In fact, interest payments on that debt relative to GDP have not gone up at all. And so I think that's a more meaningful metric of the burden of the debt on society and on the federal finances. And so I do believe we have more fiscal space, but it certainly doesn't mean that anything goes. I believe in responding to a crisis with a needed surge of spending that's temporary, that it was fully appropriate not to pay for it under the circumstances, but longer run, we do have to raise revenue to support permanent spending that we want to do.
What long-term issues could come to haunt us dealing with substantial long-term debt to the economy? In other words, it can't be a benefit for the economy except temporarily. What are some of the systemic things that could happen because of too much debt?
Well, if a country has too much debt, it may drive up interest rates. And in the process of doing that, it can crowd out other forms of productive investment in the economy, capital investment, housing, or other interest-sensitive sectors. And that may be a good thing or it may be a bad thing. It depends on what the expenditure is for. If it were, say, for infrastructure spending or for investments in people that had a very high payoff, we might decide that that was a worthwhile trade to make, but it does have the potential to crowd out private spending.
Chairman Powell, I have a question for you, if I could. The 10-year Treasury yield jumped above 1.7% last week, 1.7, which was its highest level more than a year. I think it's dropped a little since then, but the yield curve between the 2-year and the 10-year notes were 160 basis points, the steepest since 2015. What do you attribute to this uptick in yields in recent weeks, and what about the yield curve? Could you get into that just a minute?
Sure. So it seems that rates have responded to news about vaccination and ultimately about growth. So higher growth, higher inflation, lower cases of COVID. So it's, in effect, there's been an underlying sense of an improved economic outlook, and that has to be part of why rates would move back up from the extraordinarily low levels they were at, back up toward levels that we're more likely to see. And that has been an orderly process. I would be concerned if it were not an orderly process, or if conditions were to tighten to the point where they might threaten, our recovery.
Mr. Chairman, we're all concerned about inflation, price stability. That's one of your mandates at the Federal Reserve. In the event that inflation does rise precipitously and becomes an issue, we hope not, but it could, what tools would the Federal Reserve utilize or have left to maintain or work toward price stability?
Our most fundamental and well understood tools really are for that purpose, for the purpose of guiding inflation. That's really our tools that create accommodative or less accommodative monetary policy. So that's interest rates, and it's also asset purchases. So let me just say, we don't expect the kind of inflation that you talked about, but we have those tools. And if we were to face inflation that moved up and that threatened to de-anchor inflation expectations materially above 2%, then we would have those tools and we would use them in a way to guide inflation back to 2%.
What do you believe is going to be the
Senator
growth
Shelby,
rate?
wrap up if you can, Senator Shelby.
Okay, my last question. What do you think will be the growth rate of the economy, real growth, in the next 9 months?
Well, I don't have a personal forecast I would disclose though, but I will just point to the median of FOMC participants for this year was 6.5%, I believe, and that's very much, as Senator Toomey, I think, mentioned, that's very much in line with public forecasters. It's going to be a very, very strong year in the most likely case. There, of course, are risks to the upside and downside, but it should be a very strong year from a growth standpoint.
Thank you, Mr. Chairman.
Thanks, Senator Shelby. Senator Tester from Montana is recognized for 5 minutes.
Yeah, thank you, Mr. Chairman. And I want to thank both Secretary Yellen and Chairman Powell for being here today. Chairman Powell, thank you for your continued service. And Secretary Yellen, it's good to see you back in the game again.
Thank you.
I'm going to start with Chairman Powell. Following the passage of the American Rescue Plan, the Federal Reserve upgraded your economic projections. The FOMC estimated last week GDP will rebound and unemployment rates decrease more quickly. But as you highlighted already today, we still have a ways to go. Over the past year, I've shared your concerns of undershooting the economic recovery. And there are still many small businesses, workers, and families in Montana and across this country that are struggling because of this pandemic and the economic crisis it has created. How concerned are you about inflation once the economy gets on the plus side?
Well, let me say, we take the 2% inflation target very, very seriously. It's half of our mandate. So we're strongly committed to inflation at 2% over time. To us, that means inflation expectations need to be anchored at 2%, and that means that inflation has to average 2% over time. So it's absolutely fundamental that we achieve that. In the near term, we do expect, as many forecasters do, that there will be some upward pressure on prices, and also there'll be a technical thing of base effects as the very low readings from April and March of last year drop out of the 12-year calculation. We don't expect that that upward pressure will produce substantially higher prices or that the effects will be persistent. We expect that they'll be transitory or temporary. If it turns out that we do see substantially higher inflation, that would risk persistent inflation materially above our goal, then of course we would use our tools to bring inflation back down to 2%.
And from what you just said, then you anticipate there could be some upward pressure, but long term you don't see this as being an issue.
Long term, we think that the inflation dynamics that we've seen around the world for a quarter of a century are essentially intact. And we've got a world that's short of demand with very low inflation. The U.S. has had low inflation for some time, and we think those dynamics haven't gone away overnight and won't.
Thank you, Chairman Powell. Secretary Yellen, I see you're working from your home. There's a bunch of decisions that you have to make about how this money is going to go out and what it can be used for and the kind of flexibility that's out there. I'm talking about from the American Rescue Plan. Different localities face different challenges, but the fact is that there was a concerted effort to make sure that we get some money to municipalities without the state skimming off any money, and not only municipalities that are large, but municipalities of all sizes. The question is are you committed to making sure that these funds make it to the smallest of towns that haven't received any assistance yet without the state skimming off any money off the top or adding additional restrictions that weren't included in the legislation or Treasury's guidance?
Well, we're committed to following the instructions that Congress gave us, and I would agree that that was Congress's intention, where we have about 60 days to write the guidance on the use of those state and local funds. We're consulting broadly. Congress intended for there to be a lot of flexibility in how states and localities can use those funds, and we will certainly try to make sure that they're distributed as Congress intended and that the flexibility is there. Although we also want to make sure that that we have requirements to make sure the money is used responsibly in accordance with Congress's direction.
I appreciate that. When do you, you say you got 60 days to write up the guidance. Could you give me a ballpark figure? Will it take the full 60 days for the guidance for municipalities, or do you intend to get it out sooner?
We're working as hard as we possibly can on this. There are a host of issues about how to interpret the requirements of this statute. I don't want to promise that it will take less than 60 days, but we're going to try to get this done as soon as we possibly can.
I appreciate that, and I appreciate your hard work on this. I get questions all the time about the flexibility of how these monies can be used. By the way, the municipalities or counties in Montana are very thankful for these dollars. They've been running on shoestring budgets forever, and this is the first time they're going to be able to make some real improvements in their counties and municipalities, and plus being able to pay for police officers and fire departments and make sure the garbage gets picked up. So thank you very much. I appreciate both of you, and we look forward to visiting on down the line. Thank you, Mr. Chairman.
Thanks, Senator Tester. Senator Crapo from Idaho is recognized for 5 minutes.
Thank you, Mr. Chairman. And Secretary Yellen, I want to talk with you about another guidance issue that we need to focus on in the American Recovery Act. In the Act, there is a restriction on the use of funds under the State Fiscal Recovery Fund that was included that would prohibit states from using funds to, and this is a direct quote, either directly or indirectly offset a reduction in the net tax revenue of such state or territory resulting from a change in law, regulation, or administrative interpretation during the covered period that reduces any tax by providing a reduction in a rate, a rebate, a deduction, a credit, or otherwise, or delays the imposition of any tax or tax increase. Now, as you know very well, this has raised many questions and concerns. 11 of my Republican colleagues and I introduced the State Fiscal Flexibility Act last week to simply remove this troubling restriction from the law. 21 state attorneys general wrote you asking for a clarification on this issue, and a lawsuit was filed by the Ohio Attorney General. This is an issue that needs immediate clarity. And I'm aware of the letter that you responded to the attorneys general with, in which you said that you will provide guidance before the states must submit a certification under 602D1. But that doesn't really tell us how soon this guidance is going to come out. It seems to me that states are hamstrung right now. They can't do anything until you give them the guidance. Can you give us some clarity on how soon this guidance will come out?
Well, we have a 60-day period to complete the work to get the money to distribute to the state and local governments. And there are a host of thorny questions that we have to work through that connect with the issue that you just mentioned. And we simply are going to have to try to craft guidance in that period of time. We're working on it 24/7 to get it out as rapidly as we possibly can.
Well, thank you, and I appreciate that. I'm going to encourage you to do everything you can in developing this guidance to answer those thorny questions in a way that gives maximum flexibility to the states and local communities. Again, in the letter you wrote to the attorneys general, you seemed to be moving in that direction. You stated that nothing in the act prevents the states from enacting a broad variety of tax cuts. It just cannot use the revenue from the act as an offset for those tax cuts.
That's correct.
And I really appreciate that perspective. As I'm sure you're aware, that still leaves the question as to what is offsetting. How do you intend to approach the question of what is directly or indirectly offsetting a tax cut?
Well, when I said that we have thorny questions to work through, you've just indicated why we do. We will have to define what it means to use money from this act as an offset for tax cuts. And given the fungibility of money, it's a hard question to answer, but that's what we're required to do, and we will do our best to offer guidance on it.
Well, you just hit the nail on the head when you referenced the fungibility of money. And so I want to encourage you to be very restrictive in terms of the application of this prohibition and give the maximum flexibility to states and local communities as they administer these funds. I just want to ask you an example question. I want to keep pushing on this issue with you.
All right.
And I realize you may not be able to answer this any more specifically than you've been able to give specifics so far, but I'm just going to give a hypothetical. What if a state decides that, as with the federal act's waiver of federal taxation on a certain amount of unemployment compensation, the state would like to also waive a portion of its tax on those same unemployment compensation dollars? Would that be a penalty that the state would have to pay for if it did that?
So we've been asked this question by a number of states, and it's one we're going to have to consider and work through whether conforming changes that states make, for example, with respect to unemployment insurance, whether or not that would qualify as a tax cut or be exempt, and we're examining that question carefully.
Well, thank you. Again, I'm just going to encourage you again to give the states the maximum flexibility they can. They are hamstrung. And the last thing we should do is put states in a predicament where they could lose the funding that was authorized by Congress to help them just because they want to manage their fiscal policy in a way that might include some reduction of tax revenue. Thank you. Thank you.
Thank you, Senator Crapo. Senator Menendez from New Jersey is recognized for 5 minutes.
Thank you, Mr. Chairman. The Paycheck Protection Program has delivered over $718 billion in critical relief to small businesses. It's set to expire exactly 1 week from today. Secretary Yellen and Chairman Powell, is the economy at a place where Congress can safely end PPP relief to small businesses?
So, of course, the economy is not at a place where small businesses that have been affected are able to thrive. I'm not sure how much money remains in the program, but there is some, and I would be supportive of an extension.
Chairman Powell?
I would defer to the Secretary on that question. Thanks.
Well, in February, 3 out of every 10 small businesses said they would likely not survive 2021 without additional government assistance. Now, fortunately, the American Rescue Plan included $7.2 billion for PPP loans and second draw PPP loans. But if Congress doesn't reauthorize the program in the next 7 days, that money will never reach struggling small businesses. So I think it would be reckless and cruel to let the program expire when there are still about $50 billion of desperately needed PPP funding remaining and businesses waiting for relief. So I'm glad to hear that you agree that it should be extended. The Center on Budget and Policy Priorities estimates that as of March 1st, there were 13.5 million adults behind on rent and an additional 10.3 million adults behind on their mortgage payments. As we've seen throughout this crisis, the brunt of that pain is being felt in minority communities. 33% of Black renters, 20% of Latino renters, 16% of Asian renters say that they were behind on their rent compared to 13% of white renters. The American Rescue Plan included $25 billion in rental assistance, nearly $10 billion in homeowner assistance, and one of my major priorities, $100 million in housing counseling to help renters and homeowners avoid foreclosure or eviction. Now, Chairman Powell, you recently said that there is a real crisis, that when there is a real crisis, quote, don't stop until the job is done, close quote. Would you say that current mortgage and rental payment delinquency rates, particularly among minority families, indicates that the job is done?
Well, I would say actually the level of distress was very, very high and has recently been coming down a bit, but it's still quite material. And so that crisis is certainly not over.
So is providing housing support both through rental and mortgage relief what you meant when you said, quote, Congress, of course, has come with quite a strong fiscal policy? Would this be part of that fiscal policy?
I meant that statement as a general statement, that the fiscal response overall has been remarkable, frankly.
So, but a fiscal response that leaves millions of people out of their homes, whether they be as renters or homeowners, isn't going to be a fiscal response that's going to provide us long-lasting benefits. Is that fair to say?
I would say it is.
Okay. Let me ask you this. With 402 economists, the Board of Governors employs far more PhD economists in the largest university department. However, only 24% of the board's economists are minorities. Things are slightly better at Treasury. Only 30% of the 148 economists employed at the Department of Treasury are minorities. Secretary Yellen, you previously stated that if economists are mainly of one gender or race, they are likely to miss things that matter. Chairman Powell, do you agree with Secretary Yellen's statement?
I very strongly agree with it.
I'm sorry, please finish.
I'm just going to say we clearly benefit from diverse perspectives. We see that.
So let me ask you both then, considering the current makeup of Treasury and Federal Reserve economists, are either of you concerned they might be missing things that matter?
Yes, and I'm very focused on pursuing diversity and hiring to make sure that we do have diversity in the economics team at Treasury and throughout Treasury. It's a very high priority.
And at the Federal Reserve?
So this is something very, very high priority, something we've worked hard at for some time, and we're not at all satisfied with where we are. We do a lot of outreach to historically Black colleges and universities, as well as Hispanic serving institutions. I met with a group with a class actually of minority students from historically Black college just last week. Spent an hour with them. But more than that, we have a systematic program to encourage more minority kids to study economics, and if they do study economics, to think about the Fed and that sort of thing. But there's a lot of work to be done there. It's a challenge we're very focused on.
Thanks for watching, and if you haven't already, please consider subscribing to our channel. And while you're at it, please leave us a comment. Thank you for watching.